and that's evident in our short sale rule and removing the tick parameters. I think that's great. Dougie, I know you're busting, so go.
Well, the only thing I'd say is if we look at volumes, not just in Canada but globally, they are down. Yeah. The question is how much of that is truly driven off of market structure, and how much of that is driven off of other regulation that has led companies not to go public. And when you think back to the IPO process, call it 20 years ago, the average company went public within 5 years. Now it's closer to 10 years. You see companies like Facebook and Twitter and LinkedIn become mature companies, and the IPO process is just a monetization rather than a chance to equitize during the growth cycle. So the investors that really get the upside are doing it in the private equity market. As a participant in public equities who gets paid off of volume in public equities, I would love to see that volume back in the marketplace, but I understand why they're going to private equities. They're going because historically guys that have done it, like Yale and Harvard's endowment funds, have had better returns. Public companies, they manage for quarter by quarter. They have regulatory costs that are out of control. Things like Sarbanes-Oxley drive people to stay private. And so the thing that's really going to increase the public markets is making them more attractive to those companies to go to an IPO process earlier. Whether that's good for the companies or not is another discussion, and we shouldn't just consider our own self-interest, that it's great for all of us in the room if they IPO after year 4 or 5 and we get that volume. Terrific for us, and that's fantastic, but what is actually good for the economy? Is the economy being served by this 10, 12-year cycle to go IPO or not? I don't have an opinion either way, but we should understand what is the overall impact of this process, and what are the risks to the investors that are buying private equity and have this liquidity risk. They can no longer get rid of something within a year instead of, it's a year process instead of a 2 or 3 day process. But that's the bigger driver than, as much as I have my opinions on a high-frequency trading and maker-taker and the whole bit, and we don't need to get into that. I think the bigger driver of volumes is why aren't companies going public? And it's a macro thing, it's a regulatory thing, there's a whole bunch of underlying reasons. But do the public markets still serve companies? And if they do, what are we, why aren't we seeing more IPOs?
That's absolutely correct, and that reminds me of something as I read recently about the IPO market in Canada and the capital raise for startups, and there's data that shows that, in fact, like Doug said, a lot of these startups in Canada look to raise capital privately. Money is cheap these days, so they go private, they raise money, and they sell a lot quicker and a lot earlier than they would have in the past. So. We don't see a lot of companies looking to start up and go public and become, $1 billion or $100 million company in Canada. And that's definitely part of the problem. We see a lot of startups and venture companies on the TSXV, mainly for from mining and resources, where there's a lot higher need of capital. But little technology startups, there's a lot that go private. Get the money, get funded, grow their company, and sell it as soon as they can.
And being a cross-border guy and doing this for 30-some-odd years, what we have seen lately is there's a lot more business being transacted down here on the pink sheets. And so some of the interlisted Canadian stocks are being traded down here by clients and broker-dealers just to circumvent FINRA. I mean, not to circumvent them, but I mean just to be compliant with FINRA, as opposed to coming to Canada where you're going to get a better execution. They would just rather not have the headache of going across a border and doing it. They'd rather trade it on the pigs. And we have done a study, and these numbers are actually, these ones are right. 83.6% of the time, transacting in Canadian stocks, you're going to do better. You're going to do best execution is served in Canada, 83.6% of the time. But we're still seeing some clients who want to just be a one-stop shop, give it to a wholesaler, and all their FINRA problems go away, as opposed to going across the border where you might have a potential for a trade through, you might have any of those problems. So we want everybody to trade in Canada.
That's a great point. Just to highlight what Jim's talking about, he's not so much talking about stocks like, say, a Barrick Gold or a BlackBerry that's listed on both markets.
No.
You're talking about a company that's listed on the TSX, like a Linamar or a Bombardier, where there is a market maker in the U.S. making a very wide quoted market in the U.S., and some of the dealers do not want to trade in Canada, because if they accidentally, some 17% of the time, trade through that market maker quote in the U.S., FINRA's on their back, rather than have technology to figure out when to go to Canada and when to actually go to the U.S. market maker. Some of them find it easier just trade in the U.S. all the time. It's got a nickel spread in the U.S. It might have a 1 or 2 cent spread in Canada.
Yep.
And their client is suffering because of this regulation on stocks that aren't even listed in the U.S., which is just one more, a U.S. regulator putting in a rule that doesn't make sense and has resulted in actually worse execution rather than bad.
Yeah.
And which is extremely disappointing given that the barriers of entry into the Canadian market from a technological perspective, from a clearing perspective, where certainly on the interlisted names they're totally fungible between our clearing houses. I mean, the barriers are so low that there's no reason, not to access the Canadian market. And certainly from a cost, to your point, Jim, on the cost of execution side, with the spreads on a lot of names a lot tighter. It's just puzzling outside of the FINRA concern of why we don't see more of that activity.
Okay. All good? Questions? Anybody? Questions? Where's Polkari? Go ahead.
So, I think you talked about, the Canadian market versus the U.S. market. Thanks. You talked about the Canadian market versus the U.S. market. How it's cheaper, to execute in Canada versus the pink sheets in the U.S. for stocks that are only listed in Canada. But one thing you guys didn't comment on is the take fees in Canada and why they're higher than those down here. So maybe you guys could comment on that. Give it up to the panel.
Phenomenal question, and they're higher because we don't have a cap on take fees, and as the U.S. saw in 2001, 2002, when you don't have a cap on take fees, everybody drifts up their rebates to capture the passive flow, and the take fees are going to go with it. And it looks bad in Canada. The highest take fee is roughly 35 mils in Canada, higher than the 30 mil cap in the U.S. It's even worse when you consider, I think it was Phil said in the first panel, that the average S&P 500 stock is a $60 stock. The average TSX composite stock is about a $17 stock right now. So it's 35 mils on $17 as opposed to 30 mils or less on $60. Our take fees are extremely high. When I said that the HFTs make twice as much in Canada per share traded as they do in the US, a large part of that is facilitated by higher average rebate that are driven by that take fee. It's a great question, and it's something I personally would love to see addressed in Canada.
Do you guys from the exchange have anything to say about that?
Yeah, absolutely. So, I think we first introduced a make-take model in 2005 on a pilot program on the interlisted stocks, and certainly we were fairly compelled to do so, given that structure existed in the U.S. And again, in looking at the reduced barriers of entry to our market, we certainly wanted to attract and compete with the U.S. markets for order flow, and certainly on those interlisted names. And so, in order to do so, in order to win that business, we had to introduce a maker-taker model for just competitive reasons with the U.S. We obviously, when looking at the cost of trading, where those rates got pegged initially from a legacy perspective, I think incorporated the need for a rebate and a rebate level in which would attract liquidity providers to our market over and above what they were doing in the United States. So I think we started at a starting point from a legacy perspective that has just continued throughout the years. We're in a situation now where definitely there's the market is different than it was a while ago. There's certainly increased sensitivities and discussion around the make-take fees. There's certainly dialogue that's advancing between industry participants, the exchange, as well as regulators around make-take and what's the right. And we're happy to have that discussion. I mean, we're very from an exchange perspective, we're certainly sensitive to. Certainly in these kind of conditions, market conditions, which we just described, in which we have volumes down 23%, liquidity in a significant number of names on our stock, our 3,800 stock list. The liquidity is scarce, and we need to be cognizant of, if we're changing the compensation model for those providing liquidity into the market, that we don't further exacerbate a problem around lack of liquidity and volumes that already exist. So we're trying to balance that, and from that perspective, with the overall cost concerns that we're certainly hearing loud and clear from the industry.
Well,
Can I?
no, I got to get this. The maker-taker model,
Fair
first of all.
access.
Well, no, but cross-border competition for that. When I'm executing business and I've got a client order that's a held order coming from the United States, I've got to take. I'm always a taker. Commissions aren't a nickel a share anymore. Commissions are 0.0025. And if I'm aggressive, I'm paying 0.0033 or whatever the number is. That's one of my barriers to entry now. And we almost have to change our trading patterns so not to lose money while executing. And so it needs to be looked at from a cross-border standpoint, because it's expensive for me to execute for U.S. clients. I mean, it really is. And if I break even on my fees in a day, that's a great day for me. You know what I mean? So that's something that maybe should be looked at in the macro picture when we're looking, how do we do things better? Well, I need those to be down.
Like I said, we came from a certain starting place, and
Yeah.
we're it's a different environment than where we were, and so we recognize that.
Okay, Dan?
Can I say a word? Yeah.
You may.
Thank you. Just to answer your question from an exchange perspective, the make. I'm not going to get into make take or take make. It is, like Kevin said, a cross-border issue. We're competing, with the U.S. It's part of the competitive landscape. If the rules change, we'll adapt. We run a market in Australia that doesn't have a make take. We run a similar market in Japan, and we're doing well in both regions without that model. So it's all about competing. And the fact that the TMX has the highest rebate and the highest take that comes with it, allowed them to, in my mind, lock in the liquidity. The fact that they are the exchange and the main liquidity center, and they pay that level of rebates, certainly, help keep that liquidity there. As an ATS, and as somebody who's trying to challenge the incumbent, we wouldn't be able to charge 35 mils even if we wanted to raise our rebate. So our highest rebate is 24. And in terms of a cap, we wouldn't be opposed to a cap. What happens with a cap